Bob Elliott, what a pleasure to meet you. I really appreciate you coming in after a crazy week and sharing your time with us today.
Thanks for having me, Dale. Really appreciate
Yeah,
it.
really nice to have you. So, I've prepared for this interview to talk to you and uh, a little bit about Bob's background is he's the head of Ray Dalio's research team at Bridgewater. So, you want to tell us how you got from point A to point B? I mean, did you dream of being in the markets, Bob, when you were, in high school or college? How did it happen for you?
Well, I always was very connected to appreciating that markets and particularly the macro economy,
Yeah,
really drove not just financial assets, but kind of everything that we do in the same way physics drives how particles move and things like that. And that's always how I found it to be very interesting, and honestly was pretty dissatisfied with academic macroeconomics or economics in general when I went through college. So when I was looking for a job and connected with the folks at Bridgewater many years ago, as my first job out of college, I was
wow.
I was inspired by the fact that you could think about the macroeconomy in a way that was much more realistic, to be frank, like much
Yeah,
more practical and realistic than looking at what is it, ISLM curves and stuff like
right.
that, which would seem so silly at the time. And so that was really, originally my thought was I'd go for a few years and get a master's in macroeconomics, and who knows what I would do after that. But I was there for almost 15 years. Actually, I left Bridgewater in 2018, and
Okay.
now I run my own firm, my own startup
Unlimited
firm.
funds.
Unlimited
Unlimited.
funds, exactly,
Yeah.
exactly.
Wow, what a first job for someone in the industry. I mean, compared to
For
me,
sure.
Bob, you know what
For
I did? I was a runner on the CME floor for $80 a week. All right. So I learned how to take it orders to the pit and then handle out trades and my market knowledge. I got to talk to people in the pit and but wow, to be under the guidance and be mentored by Ray and his crew, you were blessed, man. What a
Oh yeah, I
great
mean, very, very, very lucky, and particularly during a time. I mean, when I started, it was 2005, which was a bit
okay.
of a quiet period in markets. But a big part of uh, what a big part of my learning was basically in the summer of 2007.
Yeah,
Ray turned to me and said, "This financial crisis, or really, then people thought it was a housing crisis,
right.
this housing slowdown, big deal or small deal, go figure it out." And
Okay.
I had to go, build a total understanding, build a total understanding of, of all the bank's balance sheets and all their exposures and
All the derivatives,
how all those structured
CBDs.
securities worked and
Yeah.
all of that. And, after doing a whole bunch of work, came back, big sheets of paper, lots of little numbers, a lot of analysis, and basically said, you know, big deal. And we were the first really to be talking in the order of trillions of dollars of losses back in 2007. And then we went and talked to all the different government officials who sort of turned gray and sort of said, because it was very fact based. It wasn't like theory based. It was very like fact based. They
Well,
all sort of turned.
Bernanke said it was contained. You should have talked to him.
we we talked to a lot of people.
All right.
And it's also important to recognize that just because a central banker or someone in the government says a certain thing publicly in order to
Oh,
manage
it's
expectations does not mean that they
PR.
aren't doing the hard work and having a realistic understanding. I mean, I think I spent time during that period counseling the Fed, the Treasury, the National Insurance Board, all sorts of different people like that to talk about what I was seeing and what was playing out. And I think the main thing that it highlighted for me is like the sophistication of the government officials is pretty high. They have a pretty good understanding of what's going on, and they also have an appreciation that they in many ways recognize there's a lot of areas that they don't know and seek out understanding in the investment community. And so, important part of being a member of the investment community, if you're ever tapped, is to go help. And that's all there is to it. And there is a discontinuity between what they may be actually thinking and understanding versus what they may be saying publicly.
What do you think the Fed is thinking now going into their meeting next month, Bob? The market's saying one thing until this week. This big regime change we've had in the last year, a lot of people are believing that we're near the end of this, and the talk is being called by the market, except we did have pretty good sell-off, and now they're taking out the generals. All last year was the troops, and now things like Microsoft and the generals are, once the troops retreat, the generals are exposed, and now they're getting hit. Where do you think we are in this market with the Fed?
Well, I think from the Fed's perspective in particular, they're laser focused on ensuring that that they are getting inflation durably back to their mandate, and particularly continue to focus on the inflation side of the picture rather than the labor market side of the picture, because the labor market's fine. Labor market's good. Yeah. It's secular. It's secularly tight. It doesn't mean a boom, right? Because our labor market, at least in the U.S., is only growing. Like labor force growth is only 0.3 to 0.5%. So even if you added 1 million jobs a year, that's still actually tightening the labor market, which people like they think back to the 2000 cycle or even the 08 cycle when that was very different. And so the labor market is good. They're focused on inflation. They recognize that the disinflation that we've seen in the recent months is a function of the resolution of the supply chain shocks from before, which created inflation. They were ultimately right in terms of transitory inflation on those goods prices. It took 2 years instead of 1 year. And so they also recognize that eventually that will stop, meaning the disinflation or the deflation in those goods assets will eventually stop, which creates an inflationary impulse, which basically would bring inflation back to the more stable or the more structural inflation pressures, which is around the services economy and wage growth. And they look at that. I mean, you get hung up on political speech. Brainerd's speech is political speech. It is not policy speech. Very important to recognize. Yes. And most Fed governors in between meetings are engaged in political speech, not policy speech. Very important to recognize. And so what they're then looking at is they're saying, I see structural inflation and structural wage growth, at least so far, and that isn't okay. And so we're going to keep tightening until we get to a point where we start to see some durable easing of labor market conditions and to bring those more structural inflation factors down. Now, what does that mean for the meeting? They're probably going to do 25 because that's what's priced in, and that's basically the consensus now. And there's kind of no cost to do 25 right now. But I think the rubber is going to meet the road when we talk about the back half of the year, where we will likely have unemployment continue to be at secular lows, wage growth continue to be elevated relative to their desires, and it's the odds that they're going to be cutting hundreds of basis points in the back half of 23 and then into 24 it looks low to me, given where we are.
Okay, so we've had a bear market, and people could call it a bear market for over a year. People think that's a long time, but don't a lot of bear there. I knew I'd get it. People are saying, well, we're already a year into it. But
well, first of all, we haven't sorry to stop you, but we haven't had a bear market.
Okay.
Right. That is a bit of a bold statement for those people who have lost money in the stock market. No, we've had a repricing of the future value of cash flows as bond yields have gone up. If anything, stocks are more expensive today, or pricing in better earnings today than they were a year ago. And that's because stocks haven't fallen as much as you would have expected if you took the change in interest rates and reflected that in the pricing of the future cash flows. And so, have we had a bear market? What I say is no, there's been no bear market in the earnings side, the top, it's earnings over discount
Right.
rates. When you think about a stock price, we have not had a traditional bear market yet.
So
And I
we
think
need
that's
an earnings recession for
I,
you to label it a bear market.
yeah. I mean, right. All assets went down because the future value of cash went, the future value of cash flows went down. But,
Right.
The market from an earnings perspective is pricing in better conditions today than they did before. Now, that's actually at some level not that surprising because nominal earnings are up relative to where we were a year ago. And even in this earnings cycle, it's important to recognize if you take out tech earnings, so far, what we've seen is a 5% earnings growth, 5% nominal earnings growth this quarter, ex tech. Okay, well, you sure wouldn't think that if you go out and read the doom media about what's going on. The reality is companies still have secularly high margins. They continue to get nominal earnings growth. The vast majority of companies continue to get nominal earnings growth. It's just basically US mega cap tech stocks, which are finally rolling over a little bit in that context.
Do you think that there's more to come on the downside? The big question is, do the October lows hold, or do we take them out before there's a better rally?
Well, I think we've got, it's going to be a challenging environment right now because we're going to get this. I mean, we are currently in this sort of transitory Goldilocks period where the Fed is going to slow their tightening. People are going to rejoice. They've already rejoiced a little bit, right? A little bit. Mm-hmm. And that's going to be a catalyst for risk taking on the very short, for very short-term traders. That's a catalyst for risk taking until we get to the point where the Fed has that trade-off against it, until we get to the point where the transitory disinflation starts to come out of the market. So we could easily get a couple of months here where stocks outperform bonds as people recognize that the economy is better than the expected immediate recession.
Yes.
Right. People expected immediate recession. That's not, it's just totally false. It's not going to happen. We're not in a recession, et cetera. And then the problem is what that's going to set up is those more stimulative conditions are going to set up a need for more tightening in the future when the macroeconomic data comes in. And so that gives you an instance where, if you're a 3-year, if you have a 3-year time frame, you should be basically not buying stocks or bonds and, just put it in cash and let it ride. If you have a 1-month time frame, you're probably going to be seeing risk assets doing okay is not that surprising in that context.
Okay. So, I've been to your website and I see that you have an affinity for alternative investments and gold was included. What's the message we're getting with the recent break, which was pretty directional, impulsive in the dollar, and almost a parabolic advance that we're beginning to get in gold? What's the message to the markets?
Well, I think when you think about gold, there's two different ways to think of it. Strategically, gold is a great asset. You should have it in your portfolio. You should have 10 to 15% of gold in your portfolio. It's a good diversifying asset that, has outperformed stocks over the last, in this century, which people very rarely seem to mention, right? No one holds gold, but it's outperformed stocks and been diversifying. On a tactical basis, I think what we're seeing is a recognition that we're transitioning from a period of tighter policy to easier policy in this transitory Goldilocks dynamic. That's creating a lot of impetus to bring, to buy gold. Gold has even, part of it has been benefited by the fact that bond yields have come down. That's for sure. But even if you look at the intraday market action, what you see is that gold is outperforming bonds, often outperforming bonds. So it's not just a yield story; it's also a story around the fact that gold is being recognized as the contra asset to what will eventually have to be easy monetary policy.
Okay,
so in general,
it's also outperforming the white stuff. The gold silver ratio has been heading up. Platinum's been under pressure. I remember in my days where platinum was at a huge premium to gold. Now at a discount.
And I think part of what you're seeing there, frankly, is when we're looking at gold as an investment asset, gold has much more liquidity. It's a much larger size market. And so if you're say a global central bank looking to diversify your reserve holdings, which we of course know is an important source of demand in the gold market, like
Yes.
the silver market, the smaller metals markets, there's just like not plausible investment opportunities for those, for people investing at that scale. And so that's why they're going to the gold market. It's a flows based dynamic here. There's no inherent reason to believe that gold should be necessarily outperforming silver or things like that. It's just like functionally, it's just a clearer, larger, more liquid investment asset for big asset holders, and I think that's basically what we're seeing.
Okay, and is the decline in the dollar going to change the narrative that the U.S. is the best sturdy shirt? Maybe there's a couple little rips in the shirt, and money is also flowing outside to Europe outperforming American markets.
We saw a dynamic where the U.S. was way ahead of the curve in relative to the rest of the world in terms of their tightening policy. And so, not surprising, the dollar rallied in that context. I think what we're starting to see is a shift, and I'd say sort of a shakeout. It used to be, if we look back over the last year, it's basically the U.S. relative to the rest of the world in terms of monetary policy. And now things are getting a bit more nuanced. So when we look at that, for instance, the dollar, the dollar tightening cycle looks weak or slower than what we're seeing in, for instance, what we will probably see in Europe. And so, the combination on the Euro side of the easing of the energy crisis, plus the recognition of a need to tighten further given the underlying macroeconomic conditions, sets up Europe as a better bet. Whereas I would put in contrast the yen, where Japan does not have an inflation problem. You can go look at the stats that came out overnight about their inflation. Inflation is moderating. It's moderating to a low level. It is, they have no problem. They will continue to run easy policy for a long time because that is what is appropriate for the macroeconomic dynamic. And so that rally that you've seen in the yen is probably overdone in that context. And so we could easily see, to be honest with you, a bit more complicated picture in the currency markets over the course of the next year than we saw, basically just buy the dollar and, it goes up relative to everything.
Do you believe that the dollar is kind of the fulcrum or the middle of the wheel and all other asset classes spin around them? Or is it the credit markets?
Well, I think I think the way I would think about that is how is, where are the sources of liquidity in the world, right? And that is the thing that you want to measure and understand. And where are the volatile sources of liquidity in the world? And obviously, the U.S. monetary policy drives a significant amount of the global liquidity dynamics. But I would, but there are, if you combine what's going on in Japan with China, with Europe, you can't forget about those other sources in an environment where they may be generating cross-cutting dynamics. And so that's part of the challenge here is like, I think there's been a lot of focus on the Fed over the last year. And as we look in ahead, it's going to be a lot. You should have a focus on how do you net the cross currents of all these different dynamics. So you can, you're going to have a situation where you're going to have, moderately, let's say the next 6 months, moderately tighter policy in the US, much tighter policy in Europe as they try to catch up and deal with their inflation problem, easing in China, and easy money in Japan. That's the dynamic that we're seeing. Okay, so how does that fit? Each economy has a different sensitivity to all those things. For instance, commodity currencies and economies have different sensitivities to that suite of dynamics than do, non-commodities or surplus countries versus deficit countries. And so you got to, that whole set of dynamics is complicated, to be perfectly frank, but one you got to net out.
The Chinese market's been a superstar in the last 4 or 5 months, and they are easing, right? So is that the reason, plus the reopening? Are you a believer in Chinese stocks, or do you feel uncomfortable about possible draconian moves that occurred there in China?
Well, I think there's two different approaches to this. Like I think from a strategic perspective, personally, I don't invest in Chinese stocks. I'm not particularly interested in it. It's not that the incremental diversification is not worth, frankly, the hassle of something that is not necessarily a market dynamic. I'm not saying it isn't a market dynamic, but it certainly could lead to a circumstance where it isn't a market dynamic. So I wouldn't trade the stock market versus, say, the currency, which is much more, globally traded and liquid, and they can't do that much to it relative to the macroeconomic forces. That being so, anyway, you could take that or leave that. You don't have to trade every market if you don't want to trade it, and that's a totally fine way to operate.
Bob, I saw guys that never left one trading pit that did pretty well. They knew one market like the back of their hand.
Right. I mean, whenever you're trading anything for alpha, the question is, do you have an edge? Do you feel like you can outpredict the market? I don't think I can outpredict the market when it comes to predicting, the Chinese Communist Party's policies. That's
tough gig.
That I don't think I can predict it. There you go.
Yeah.
That being said, if you thought about it solely from a macroeconomic lens, what you'd see a situation which is very negatively correlated essentially to what we're seeing in the US, which is a much earlier cycle dynamic in need of monetary stimulation and fiscal stimulation that's starting to come online. It will probably pick up. And so when you look at that whole dynamic, that's very different from, Western economies that have, inflationary problems with, with tightening and that are late cycle. And so Chinese stocks and bonds in general look better than US stocks and bonds in that from a macroeconomic lens. Now, whether or not you choose to trade it, that's a different story.
Okay. Do you have a view on, besides what happened with FTX, do you have a view on Bitcoin?
I led Bridgewater's research on Bitcoin years and years ago when it was just, I remember it was like at 500 or something like that. And I went through it and I basically, learned a lot about it and the whole infrastructure stuff like that, and recognized that Bitcoin is not a currency. It is a different, and I mean that.
What is it? What is it?
Very importantly, it is not a currency. And therefore the macroeconomic drivers that drive currencies, which is where I feel like, one of the areas where I feel like I have edge, and in general, the macroeconomic drivers don't really apply to what's going on in Bitcoin. And so what is it? It's an asset that people trade. Is that, and it's driven by all the different things that, it's driven by a wide variety of factors. What I would say is the one perspective that I do have is I've traded a lot of pegged or heavily managed currencies in my career. You can tell the writing, whether countries are explicit about it or implicit about it, you can tell when markets are being manipulated by central authority in terms of how the day-to-day market action works and how it responds to various pricing. I look at the Bitcoin market, it looks like a manipulated market to me today and has been for an extended period of time. And so the combination, I'd say, of a manipulated market with one that doesn't connect to macroeconomic drivers, not an asset I'm interested in trading. I don't have a particular view. It could go up, could go down. Honestly, I think whether it goes up or down is probably a function of what the small handful of holders are able to do relative to the small scale guys that are frankly trying to get out of it. Mostly, that's what it looks like. So it looks like a manipulated market. If you have an edge in that manipulated market, go for it. But I certainly don't.
Okay, so talking about central control, there's really not that much talk about what's being beta tested by the Fed, the CBDCs. Do you have a view on that? Because I think it could be one of the biggest financial stories. It's the biggest monetary story, I think, since Bretton Woods. And not many people talk about it. Do you push back on it and hope it doesn't happen? What are you telling your people to get prepared for what looks like it's going to be inevitable?
Yeah, probably. Like the idea that we're going to move towards a world, we have physical cash today to engage in transactions that are outside the banking system. And there's all sorts of good reasons why. There are good reasons why people want anonymous transactions that are instantaneous and don't flow through the banking system. I think, the Fed is rightly, the Fed, and it's not just the Fed, the Bank of England has a bunch of work on this. Actually, the PBOC has done a fair amount of good work on this. And there's some good reports by the BIS who's sort of spearheading the research on this topic. And, they're basically sitting there saying, 20, 30 years from now, there will be no paper cash. What will replace paper cash? What will work in that context? And can we start building the rails related to that? And so it would make sense to me that we would get something like a digital dollar and a digital yuan and a digital sterling and stuff like that. That would make a lot of sense. And the truth be told is we kind of need a reform in this space. Like as anyone who's in the middle of the financial markets knows, like we're still running on rails built in the 70s, right?
Yeah.
In a lot of the U.S. financial system and the clearing infrastructure. And so, these two things intersect with each other a fair amount, recognizing that we need next generation technology for financial market transactions throughout the financial system, combined with the desire to have the transactability and anonymity of a digital currency. And so I think we're gonna start to see solutions emerge, but it's gonna, it's even money whether this, by the time I retire, whether that's where we are.
Okay, because there are people worried about the privacy issues of it and the surveillance issues of it and social credit scores and so forth, like are occurring in China. That
sure.
the government could actually, not be happy about, say I take a trip and I go and pick up some cigarettes and then a bottle of tequila and then shop at a marijuana dispensary, that it might lower my social credit score. Anyway, that's
it'll improve your social credit score in all of our estimations. So
all right, well, I want to wrap it with you because I believe you have an ETF, HFND.
Yeah, HFND is our first ETF, and what it does.
Congratulations!
Thank you. It's what it does is it replicates the returns of the aggregate hedge fund industry using a combination of our experience having built the proprietary strategies, as well as modern machine learning techniques to do that. And so we launched just over 3 months ago and have right around 60 million, and it's the fastest growing independent actively managed ETF launch of the last few years. And so, if it's appropriate for your portfolio, or you're interested in thinking about how to, in a simple, easy way, get access to hedge fund style returns, at a much lower cost and in a more liquid instrument than typical LP positions, you can check it out on our website.
Yeah, so go to check out Bob. You could follow him on Twitter at Bob E Unlimited, and go to his website www.unlimitedfunds.com.
You got it.
Really pleasure meeting you, Bob. But
Dale, it was a lot of fun.
Yeah,
I love the rapid fire questions.
I call
cover everything. 30 minutes. Yeah. Boom. There you go.
And we're now Trading Warrior Brothers. Anyone I do an interview with, so you're now my Trading Warrior brother. Like
there
it or not,
go.
Bob. Really,
thank you so much for having me on.
Yeah, rooting for you, and may your new ETF grow like a mushroom.
Perfect. I'll see you later.
I appreciate it, Bob. Bob Elliott, everybody.
See you later,
Thank you,
folks.
buddy. All right, everyone, that's a wrap, and you could join the team in 15 minutes on the Morning Edge. Hope you guys have a great weekend. You're welcome, everyone. Glad you enjoyed Bob, and we'll see you next week. Have a great weekend. Don't just count your pips, count your blessings. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.